Hi, in this video I'm going to share with you 3 different ways to measure your investment returns. We're going to focus on simple rate of return, time-weighted return, and money-weighted return. And so that way, by the end of this video, you're going to have a clear understanding of how you can measure your investments and ultimately help you make better investment decisions. My name is Yvonne, and the goal in this channel is personal growth. So if you want to improve the quality of your life, click the subscribe button to level up. So let's get right into it. The first way that you can measure your investment returns is by using something called a simple rate of return. And the simple rate of return is used to measure the profit or loss of an investment over time. It doesn't consider any cash flows in or out of the investment. And so a simple rate of return is really the net gain or loss of an investment over a specified period. And it's expressed as a percentage of the investment's initial cost. So that way, when you're calculating the rate of return, what you're doing is that you're determining the percentage change from the beginning of the period until the end. So a rate of return can be applied to any investment vehicle, from real estate to bonds, stocks, and fine art. And this simple rate of return is sometimes called the basic growth rate, or return on investment, or ROI. So if you hear those words, you'll know that this is the simple rate of return. Sometimes these terms are used interchangeably. So for example, let's say that as an investor, you buy a stock for $100 a share. Let's keep it simple. So you sell the stock for $120. Well, your gain is 120 minus the 100, that's $20. So a capital gain is the difference between your purchase price and the value of the security when you sell it. Right? So in this case, let's say in addition to the money you made during the sale of your share, you also earned $10 in dividend income. Again, we're keeping it simple. That makes it a total gain of $20, which was your capital gains. Remember, 100 minus the 120, that's the $20 capital gain, plus the $10 dividend that you got. And since there are a lot of beginners here, I just want to clarify that a dividend is a payout to shareholders from the profits of a company. So it's not the same as the capital gain that you get from the profit. So anyways, again, with the $20 capital gain plus the $10 dividend, that equals to a $30 gain per share in total. So the rate of return for the stock is $30 gain per share. So in order for you to get the percentage growth, what you do is you divide the $30 gain per share by your initial $100 cost per share, and that gets you to 30%. So your simple rate of return is 30%. Remember, I said in the beginning that it's based on a percentage, right? It's expressed as a percentage. So that's what you want to do. So this number is helpful to get familiar with so that you can assess what your rate of return is for your investments. And now that you know how to calculate your rate of return, you can go ahead and try that calculation for your investments. Or one fun tip that you can do is begin to get comfortable with these types of terms and have a conversation on simple rate of return with maybe your family or friends that are also interested in personal finance and investing. So that way you could get more comfortable with the language, because truly personal finance and investing and all that is a different language. So get familiar with speaking that language. Okay, so the second way to measure your investment returns is using a time-weighted rate of return. And see, that measures the performance of an investment portfolio by taking a single investment and measuring its growth or loss at the end of a time period. And it's a measure of the compound rate of growth in a portfolio, and it doesn't include the effects of the deposits or withdrawals on the account. Okay, so that's important to be clear on. I'm going to repeat that. It doesn't include the effects of any deposits or withdrawals or fluctuations in the account. And so this helps to compare investments, because essentially what you're doing is you're comparing vanilla to vanilla, right? If this investment were consistent over time, what would it look like, right? As opposed to the ebbs and flows, the investments, the withdrawals, right, that happens during a natural course of an investment. So take this with a grain of salt. It's not realistic. It's not going to tell you what really happens. It only gives you an opportunity to be able to compare vanilla to vanilla, investment to investment. I hope that's clear. So that's the only real purpose or value to this, is to be able to compare. So anyway, so time-weighted return lets you see how your investments performs without your changes, which lets you again compare to similar investments. And I want to stop here and clarify that these types of measures are tools. All right, pretend that you are maybe a construction worker, or maybe think of a handyman, right? Depending on the kind of job, or depending on the kind of situation, they're going to use a different tool, right? For some things, they'll use a hammer, right? For other things, they'll use a screwdriver. For other things, they'll use a different tool, right? Maybe a plier. So I want you to start thinking of these measures as tools, depending on the situation. It's not like you're just going to use one measure, right? The simple weight of return, or the time-weighted return, or the money-weighted return for everything. No, it depends on the situation, right? In the situation where you're only trying to compare similar investments, this is a good one. And so the key takeaway here is that time-weighted return is primarily used by investors and investment brokers to compare investments. And one thing to watch out for here is that the returns reported by mutual funds are based on a theoretical person who invested all their money on day one. And that's not true for most people. So don't fall for the marketing tactics when you see tempting returns, right? What they're showing is a time-weighted return, assuming someone invested on day one for the full year, right? That lump sum without changes. When you look at that brochure, for instance, from the mutual fund, you're going to see what's called a time-weighted return. So if the shiny brochure says 6%, the investors actually, 6% is this ideal scenario when they put the lump sum all in the beginning of the year, day one, January 1, right? Nothing changes, boom, 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 6%. Yay, right? Pull out the champagne. The mutual funds in the brochure, right? And they try to sell it to you. But the reality is, an investor is going to have the realistic experience, right? Where, for example, for starters, they're not going to invest all their money all up front. Generally, an average investor, they're going to, put a little bit throughout the year, right? And there's fluctuations. They might take out money. They might put in money. So an investor actually is making 3%, for instance. Why? Because the truth is, investors rarely have all their money in the fund at the beginning of the year. So the reality isn't like the way they're showing at all. So their scenario is not a true representation of what we earn. So for example, if you have a 401k set up, you know that you invest little in each paycheck, maybe more when you see the fund is performing well, and maybe you'll invest less when it's not performing, right? So the truth is that to truly understand your investment, you want to account for all the deposits and withdrawals and peaks and valleys throughout the year. So you want to find out how much are you really making, right? Or losing. That's where the next tool comes in. It's called the money-weighted rate of return, okay? So, and that leads me to the third way to measure your investment returns, and that's using money-weighted rate of return, or what's typically also heard of as dollar-weighted return. And so what this is more like a real-world approach, okay, more realistic. And it's a measure of investment performance that considers the timing and the amount of cash flows both into and out of an investment. It's also known as the internal rate of returns. You might hear that. Okay, again, like I said, sometimes words are used interchangeably, so it's good to get familiar with all of these. Okay, so the money-weighted rate of return is an investment performance measurement that lets you see how your investment has performed while accounting for your investment activities, like adding more capital through contributions or reinvesting dividends, which happens a lot, right? So it calculates the performance of an investment that accounts for the size and timing of deposits or withdrawals. So the money-weighted return allows you to see how your changes affect your investments, letting you see how your decisions affect your investments. And that's essentially what a lot of people want to see as well, right? So here's the thing. At the end of the day, the goal of investing is to get the maximum return with the lowest risk possible, no matter what approach or what measure you use. And see, the more you learn about investing, the more confidence you're going to gain when it comes to investing, because you know what to look out for when you're assessing an investment to see if it's the right investment for you. And as always, I encourage you to reach out to a financial advisor as part of your team, but also use your own common sense logic, because it's your money at the end of the day. Again, the financial advisor is good. Also, other folks to have on your team, CPA, so that they tell you or help you understand how it affects your taxes. But at the end of the day, it's your money. No one's gonna take care of your money better than you. So you've got to learn these things so that you can make the right and the best decision for you. So when you begin investing, I want you to pay attention to the way these mutual fund companies share their rate of return, and understand that they're using a different calculation than reality. Remember, they assume a time-weighted return, which is assuming that the full lump sum is invested at the beginning of the year with no fluctuations. But that's not reality, right? So for most investors, what you want to do is be aware of this so the wool isn't pulled over your eyes. You want to know the true rate of return on your investment portfolio based on real numbers. And that's where money-weighted return comes in. Always remember, if a mutual fund is selling you something, ask them how it's measured, and then tell them, hey, how does it look like by this type of measurement, the money-weighted rate of return? And then, that'll flow a different kind of conversation, right? So anyway, knowing the difference of all of these measures and more can help you become a wise and savvy investor. And that's what we're looking for, all of us. In this community, we're all in it together. I'm learning, you're learning. So in investing, there are many different approaches and strategies to help you set yourself up for financial freedom. But you know what? It can be pretty overwhelming to do this all on your own. Remember, as I said, it's like a new language. And that's why I've designed my signature program, the Money Mastery Program. Here, I share everything that I've learned so far, and I'm always learning. I'm always growing as well, okay? And so as I learn and grow, I add modules to the Money Mastery Program. So it's truly a growth community. So if you're ready to invest in your financial education, this course is for you, because it combines getting the full picture of personal finance and really helping you create a personalized financial action plan. And it really puts the power back in your hands where it should be. It empowers you. And this program is especially curated for those that are ready to upgrade their mindset for wealth, because it starts there. It starts with our mind. And this exclusive experience is for high achievers that are really committed to their transformation, to get out of debt, to save more, to increase their income, and invest to build generational wealth. And this program is really going to support you to have that peace of mind that comes when you have an action plan for financial freedom. So if you're ready to live a life of financial prosperity on your terms, click the link below on the description. It's very windy out here. Click the link below in the description to enroll. Also, go ahead and check out my Goals Mastery Program. If you feel the need for more clarity in life, this course is going to help you get clear with what you want in life, and also help you identify and align with your vision, your mission, and your goals. You see, we don't want to just flail through life, okay? Because if we're not clear with what we want, if we're not clear with the vision that we have for ourselves, then we're working towards somebody else's vision, somebody else's mission, somebody else's goals. And they're imposed on you, whether you are aware of it or not. So let's go ahead and get clear, okay? Also, too, it's always great to have inspirational and motivational reminders to keep you moving forward towards your dreams and goals. So click the link below to choose your favorite custom designed gift for yourself, family, and friends in my online merch store. Click the link in the description box below to get your favorite. And also, if you enjoyed this video and want to improve the quality of your life, click the subscribe button to level up, and I'll see you on the next one. Oceans of love. Till next time.